Right now, if you walked into your bank and asked for all your money in cash, they couldn't give it to you. Not because they're corrupt, not because they lost it, but because it's not there. In fact, if just 10% of depositors showed up tomorrow asking for their money back, most banks would collapse within hours. This isn't a conspiracy. It's not a glitch. It's the design. And somehow, this terrifying system is exactly what keeps the modern economy running. Here's what most people think happens when you deposit money. You hand the bank $1,000. They put it in a vault with your name on it. When you need it back, they hand it over. Clean, simple, safe. Except that's not even remotely how it works. The moment your money touches their system, something strange happens. That $1,000 doesn't sit idle. It multiplies, it moves, it becomes someone else's mortgage, someone else's car loan, someone else's credit card debt. Your money is everywhere and nowhere at the same time. And the really wild part, this isn't some shadowy practice buried in fine print. It's the foundation of banking. It's taught in universities. It's protected by law. So let's walk through exactly what happens to your deposit the second it leaves your hands. Let's say you deposit that $1,000 into your checking account. The bank thanks you, updates your balance, sends you a confirmation, and then immediately lends out $900 of it. This is called fractional reserve banking. The bank keeps a fraction, usually around 10%, and loans out the rest. So your $1,000 is now split. $100 stays, $900 leaves. But here's the trick. Your account still says $1,000. You can still spend it, transfer it, withdraw it at an ATM. The money hasn't vanished from your perspective. It's just that the bank is betting you won't ask for all of it at once. Now watch what happens next. That $900 gets deposited into someone else's account. Maybe it's a business, maybe it's another person. That bank now takes 90% of that deposit and lends it out again, $810. Then someone deposits that and the cycle continues. By the time this chain reaction finishes, your original $1,000 has turned into nearly $10,000 floating through the economy. 10 times from one deposit. This is called the money multiplier effect. And it's why economists say banks don't just store money, they create it. But let's be clear about what that means. It means the vast majority of money in circulation doesn't exist as physical cash. It's digital, it's promises, it's numbers on a screen backed by the assumption that not everyone will want their money at the same time. Which brings us to the uncomfortable question. What happens when they do? In the United States, banks are required to hold around 10% of deposits in reserve. Some hold a bit more, some, since recent policy changes, hold almost nothing. But let's stick with 10%. That means for every $100 deposited, only 10 stays in the vault. 90 is out the door. Now imagine a bank with $10 billion in deposits. Sounds huge, right? It's actually only holding $1 billion in reserve. If 11% of customers ask for their money on the same day, the bank is out of cash. And here's the darker math. During the 2008 financial crisis, several banks experienced withdrawal requests exceeding 20% in a single week. Not because people were panicking over nothing, but because they'd seen the news, they'd heard the rumors, and they did the rational thing. They wanted their money. The term for this is a bank run. And when it starts, it doesn't matter if the bank is healthy or not. Perception becomes reality. Because remember, the money isn't there. It never was. Now here's the bizarre part. This system, this house of cards built on borrowed time and collective trust, is actually why your savings account earns interest. It's why you can get a mortgage without waiting 30 years to save up the full amount in cash. It's why businesses can expand, students can pay for college, and governments can fund infrastructure without hoarding gold in a basement. Fractional reserve banking is fragile, but it's also incredibly efficient. It turns idle deposits into productive capital. It greases the wheels of commerce. It allows the economy to grow faster than it ever could if every dollar had to sit perfectly still in a vault. The trade-off is risk. You're trusting that the bank made good loans, that borrowers will pay them back, that regulators are watching, that if something goes wrong, someone will step in, and most of the time, that trust is rewarded. But not always. So why doesn't this system collapse more often? Two reasons. The first is deposit insurance. In the U.S., the FDIC insures deposits up to $250,000. If your bank fails, the government covers your loss. This removes the incentive to panic. If you know you're protected, you don't rush to withdraw. It's a psychological firewall. The second reason is the central bank. The Federal Reserve can inject liquidity into struggling banks overnight. It can literally create money to stop a run before it spreads. This is why 2008 didn't become 1929. The system bent, it cracked, but it didn't shatter, because the Fed acted as the lender of last resort. But here's the tension. Every time the government steps in to stabilize the system, it reinforces a dangerous idea that banks can take risks because they'll be bailed out, that the downside is socialized while the upside is private. And it raises a deeper question. If the system only survives because of constant intervention, is it really stable, or are we just getting better at managing the inevitable crises? Your bank doesn't have your money. It has a promise to give it to you when you ask, and most of the time, that promise holds. But the system only works because we all agree to look the other way, to trust the math, to believe that the 10% reserve is enough. It's a collective act of faith. And maybe that's fine. Maybe fractional reserve banking is the least bad system we've come up with for turning savings into growth. But it's worth remembering what it really is: a bet. A bet that you won't all show up at once. A bet that confidence won't crack. A bet that when things go wrong, someone will be there to catch it. So far, that bet has mostly paid off.